Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Hope you're well. Here we are at the end of the first week of May. April was pretty wild, and have some information that we'd love to communicate with you about the month of April, as well as looking forward to the rest of the second quarter. So first, four major indices. The S&P 500, so the 500 largest companies in the United States, is down about 3.3 year to date. The NASDAQ, a little bit more technology focused. Several of the Magnificent Seven names are in there, down about 7%. Stocks outside the United States have had a great year so far, up a little bit more than 10%. And the bond market is up about 2. So we've got two positive indices and two negative indices. Uh, in terms of the S&P 500, sort of going back to the start of 2024, sometimes it's easy to lose sight on what the market trends are and really just get focused on what the last few days or few weeks or even what the last month was. Going back to the start of 2024, the S&P 500 is up about 21%. Over the last 17 months, we've had 11 positive months and 6 negative months. So the trend is still quite good. Um, April was certainly a volatile one, but overall, going back to the start of 2024, the S&P is up about 21%. In terms of market leadership, it's interesting how markets can be quite cyclical over time. If we take a look at year to date, we've got, of course, 500 companies in the S&P 500. Five major leaders would include Netflix up 28%, AT&T up 23, Berkshire Hathaway up 13, Coca-Cola up 15, and Costco up 10%. That's very different from some of the leadership which we've seen in previous years, names like Microsoft and Meta and Amazon and Apple and Google. So there's been a bit of a rotation of leadership. Year to date, the Magnificent Seven companies represent an influence on the S&P 500, dragging the S&P 500. Those seven companies down 4.3. The other 493 companies are up and have an impact of about +1. So we've seen sort of a change of leadership over the last few years. We're certainly aware of how those seven companies can influence the overall index. In terms of a balanced portfolio, if we were managing a balanced portfolio, for example, and that balanced portfolio is constructed 60% stocks, 40% not stocks. If the 60% stocks was 40 out of 60 S&P 500, 20 out of 60 international stocks, that type of balanced allocation is up slightly on a year-to-date basis. And I feel sometimes there can be almost like a disconnect between what might be on television about how poorly the market is doing, or what sort of headlines I might see on the internet about how poorly the market is doing. And when we look under the hood at what a diversified portfolio is doing, in this example, a 60/40, balanced portfolios are slightly positive for the year. And the long-term average over for a balanced portfolio is close to 7%. So balanced portfolios are showing this year what diversification can accomplish. April was historically volatile. This is year 25 for me of being in this position professionally. Those 25 years included the dot-com bubble, the Great Recession, the COVID crisis, and then this past April, I don't know yet what the historical term for it will be, but we'll say volatility related to tariffs and trade for now. So there's a measurement that we use regarding volatility or fear. It's called the VIX, VIX. It's a fear gauge. And normal volatility is quantified in like the teens. When it goes past 30, that's considered high. And what we've circled here on this slide are the instances in the past when it actually hit 50. So this is the Great Recession, this is COVID, and then this is April. And it certainly felt the same. But interestingly enough, when we see this type of fear, when we see this type of selling, it does present excellent entry points for buying. And if we take a look down at the bottom, when we've had previous instances of the VIX going through 30, and in these instances, it's through 50, the forward-looking 3-month, 6-month, 9-month, and 12-month returns in terms of what the S&P 500 has returned in the past, um, it is compelling and attractive. And of course, past performance doesn't mean it's going to happen again, but certainly could have provided an excellent entry point in April for portfolios where there was some buying done. Again, having a period during the year where the market goes down is normal. The average intra-year drawdown going back to 1980 is 14%, meaning we come into the year expecting there will be maybe a 14% decline at some point in time. In 2025, again, the average is 14. In 2025, we saw the S&P go down 19. So it's really not totally unusual to see drawdowns. And if you look at the left column here, the left column shows us each year what the drawdowns are. And then the column to the right shows what was the final return for the market that year. So there's been dozens of years in which the market had a significant drawdown, but still finished positive for the year. So it would not be a surprise if 2025 wound up being a positive year, because there's certainly been years in the past where we've seen a drawdown in excess of 19% and the market still finished positive. So the pace in which things declined in April is unsettling and probably a little unusual, but seeing a market go down by 19% and still having a positive year at the end of the year is certainly within reason. In terms of opportunities that may have presented themselves, basics of investing, of course, are selling high and buying low. And what you can see here, just a nice way to illustrate it, we've got three of the major indices. We've got international investments, which is the orange. Right now it's up 10.5%, but at one point in time, not too long ago, about 6 weeks ago, it was down 2 or 3% for the year. We have the bond market, which has been pretty steady all year long and up about 2%. And then we have the purple line, which is the S&P 500, which bottomed out down about 15% for the year, and right now is down about -3. So from a trading perspective, if there was an opportunity to maybe sell a little bit of bonds or maybe even sell a little bit of international and buy a little bit of S&P earlier in April, that would have been a trade that's paid off nicely in terms of buying low and selling high. So rebalancing is important. And in many portfolios, we were active in the second week of April. In terms of the economy and what's really happening with the economy, two of the inputs within gross domestic product or calculating gross domestic product is the difference between imports and exports. Clearly, earlier this year, the fears about tariffs, the fears about trade wars led to many individuals and many businesses accelerating what they were importing to build up inventories, to sort of stockpile goods that they were going to potentially need if we were going to be in a position of having high tariffs for an extended period of time. So GDP was negative, but it was not negative because the consumer stopped spending. It was negative because the difference between imports and exports led to it to be negative. If we take a look at, are people still spending money? Yes, they are. In the first quarter of 2025, consumer spending was nearly 2%. It's certainly down a bit, but GDP in terms of personal consumption, still positive. And if we take that a bit further, certain businesses need to refine and change their expectations in terms of how profitable they will be based upon what's happening with trade and tariffs. I think on an earlier video, perhaps one back in February, we showed that the forward-looking guidance in terms of what earnings expectations for American companies was growing those earnings by 15%. Those have since been revised down 3 months later because of the uncertainty about how are some of these tariffs or trade wars going to impact company pricing. And it's now been revised down from 15% to 9%. The market knows that. The stock market's pretty much priced that in already. So we're still in a position of positive earnings growth, but it's not as positive or not as optimistic as it had been 3 months ago. And that could certainly change. I mean, it certainly seems like on a weekly basis, we're getting revisions out of Washington in terms of what the trade policies are going to be. We anticipate that there will be ongoing negotiations with our major trade partners. And where we were at the start of April, coming out of Washington, was potentially sort of the most firm and harshest stance. And we anticipate that that'll be quite different from where we wind up. Finally, unemployment in terms of how our economy is doing. We'll get asked a lot, are we going to be in a recession? Are we in a recession? It's difficult to see us being in a recession when people are still employed and getting paid the same amount of money as they were getting paid before. I think we would need to see a substantive change in the unemployment rate, companies laying people off, people not getting paid, therefore not being able to consume, to really have an impact on our economy. So right now, the unemployment rate remains right around 4%, which is a really good place from a historical standpoint. Be interesting, obviously, to see how this changes over the next month or two. But right now, Unemployment seems to be pretty steady. And in terms of inflation, the data there is quite good as well. We've certainly come a long way from where we were a few years ago in terms of where CPI and inflation is. And we've made a heck of a lot of progress in terms of inflation over the last 2 or 3 months. Where, in terms of the CPI is sort of in the mid twos to low twos right now, which is a good place. So the economic data that we're seeing there, in terms of the short-term impact of trade and tariff worries, unemployment is remaining pretty steady, and CPI or inflation remains reasonably low. So April was a wild month. It's our job as advisors to do a number of things. First, not to be emotional, to be calm, to sort of be a steady hand on portfolios, not to overreact to whatever the latest headline is of the day, or not to overreact on what the latest comment is out of Washington, but to pay attention to real data and real earnings and real trends. And probably from like a psychological standpoint, our job is to try to keep our clients from doing something silly, something emotional, or making an irrevocable move on something based more out of emotion than fact and data. So it was wild, but we've made it through. And we'll probably be back in touch again in a month or so with some additional updates. We'll see what the world looks like, and we'll see what the latest is with trade and tariffs at that time. Of course, if you have any questions, please don't hesitate to reach out to the advisor in the firm that you communicate with the most. We appreciate the trust and the confidence, and thanks for delegating all of your worries to us during April. We sincerely appreciate it. So thanks very much, and we'll see you soon.